If you've spent any time looking at Forex charts, you have seen this tiny cross-shaped candle. It is the doji, and it is one of the most common and consistently misunderstood patterns in trading. The pattern is so distinct that it creates a psychological trap. Novice traders spot this exact cross shape and assume it means the current market trend is over and a reversal is starting immediately. This chart shows the trap. An upward trend peaks with a doji. Traders short the position, watching a massive upward spike blast right through their stop loss. These triggered stops become forced buy orders, giving larger players fuel to push the trend even higher. Treating that isolated cross shape as a guaranteed reversal signal isn't technical analysis. It is essentially gambling on a coin toss. To use the doji correctly, we have to recognize its singular actual message, a temporary state of absolute market indecision, a stalemate between buyers and sellers. Looking at this diagram of a candlestick forming, you can see exactly how this equilibrium happens. During a specific trading session, the asset's opening and closing prices end up being virtually identical. Because there is no difference between the open and close, the thick body collapses into a single horizontal line. The lines extending above and below that center point are the wicks, or shadows. They map the extreme high and low prices reached during that session's tug of war, before the market settled right back where it started. Variations in these wicks tell specific stories. A gravestone doji features a long upper wick. Buyers pushed the price high, but sellers stepped in with overwhelming force to drive it all the way back down to the open. The dragonfly doji is the exact inverse. It has a long lower wick, showing that sellers drove the price down only to hit a wall of buying pressure that pushed it all the way back up. By reading the length and direction of these wicks, you can identify exactly which side of the market exhausted its momentum. But the shape of the candle alone is incomplete data. A doji's structure is meaningless without understanding the surrounding market context. If a doji appears in the middle of a choppy, sideways ranging market, it merely confirms the existing lack of direction. It is background noise, and you ignore it. This line chart illustrates a highly significant scenario. A long market crash hits a historical support level, a proven price floor, and prints a dragonfly doji precisely on that line. Even at this extreme exhaustion point, the doji is a yellow traffic light, not a stop sign. It signals a pause in the downward momentum, telling you to slow down and prepare for a potential shift in direction. Evaluating the pattern against the macro trend separates random price glitches from highly strategic, actionable warning systems. To translate that warning system into a trade, there is a non-negotiable rule. You must wait for the confirmation candle before executing an order. If the doji represents perfect indecision, the market asking what's next, then the very next candlestick is the definitive answer. Let's construct a complete bullish reversal setup. First, you identify the context, a severe downtrend that has just collided with a major weekly support zone. Second, you locate the signal, a dragonfly doji forming exactly at that support barrier, indicating that sellers are running out of power. This diagram shows the final critical step. The subsequent candlestick must be a strong, bullish candle that closes completely above the doji's highest wick. By demanding this exact sequence of context, signal, and confirmation, you align your entry with actual returning market momentum instead of blindly trying to predict the bottom. Because no technical setup works 100% of the time, precise stop-loss placement is the critical final step of this strategy. Looking at this diagram of our confirmed setup, the structural extreme of the pattern provides your logical boundary. You place your stop-loss just outside the extreme tip of the doji's longest wick. If the price breaks that level, your thesis is invalidated. You can also use this exact logic defensively. If you are holding a winning position and a doji appears against your trend at a resistance level, it is a primary signal to secure partial profits. Mastering market context and requiring structural confirmation turns the doji from a common trap into a tactical weapon. You can test this rules-based framework today on an FXNX demo account.